What's going on, everybody? Welcome to Forex Accelerator. This is the no BS guide for trading Forex. And this is going to be really quick. This is just a brief overview of Forex for people that have never heard of it, just to give you an idea about Forex before we start getting into the good stuff. So, my name is William, and if you're a part of this training, thank you for signing up and pay attention. So, let's get it going. Why should you trade Forex? It's crisis proof. Unlike the stock market, real estate market, and retail sector, Forex can remain profitable even in the worst of times because currencies are always traded in pairs. You can make money regardless of whether the market is trending up or going down. So basically, when you're trading stocks, if the market crashes, the stock market crashes, then you lose your money. Your 401k is down, everything's bad. Real estate market, same way, your properties lose value. With Forex, we make money on the incline and decline. So if the market is going down, we can still make money. So that's why I like Forex. Work from anywhere in the world. With Forex, you can work anywhere. You can work from your computer or your smartphone. I trade on my phone. I check out the charts on my computer, but you can do it from your phone as well. You start with just $100. This is true. When I started, didn't have a lot of capital. I started with $100, flipped it, kept going from there, lost it, made it again. So I'll also tell you some of my mistakes that I made. That's the importance of having a mentor, is they can help you keep from making those mistakes that they made. So it's very important that you get a mentor when it comes to trading. Even if I'm not your mentor, that's fine. Just find somebody that you can relate to. Easy to learn. There's only 8 base currencies to learn, and we're only going to be choosing one. That's the problem with most beginners. They try to follow all these different currencies. People that join these different groups and they have you watching all these different currencies, you get confused. You need to learn how one currency moves. You need to focus on one thing. You can sell at any time. With a daily turnover more than $5 trillion, Forex is the most liquid financial market. In other terms, there's always a buyer when you want to sell, and there's always a seller when you want to buy. This is true. Forex is a very active market. There's plenty of buyers, plenty of sellers. If you didn't know, Forex stands for foreign exchange. The foreign exchange market determines the relative values of different currencies. The price of a currency is actually a reflection of what the market thinks about the current and future condition of a country's economy compared to other economies. When you buy the US dollars with British pounds, you're in fact buying shares of the US economy, expecting the US economy to outperform the UK economy. So let's say you buy Euro USD, EUR USD. You're actually buying euros and you're expecting the dollar to fall compared to the euro. And with this example, they were talking about pounds, but I want you to start brainstorming here, thinking about USD JPY, Euro USD, uh, Gold USD. You want to think when you hear that first term, you know you're buying that and selling the other. So there's 3 type of currency pairs, and they're divided into majors, crosses, and exotics. You won't be trading any exotics. We won't be trading any crosses. You'll be doing all major. Um, Majors represent developed economies and highly liquid with low spreads. So the majors include Euro USD, GBP USD, which is the pound, USD JPY, which is the dollar versus the yen, USD CHF, which is chef, USD CAD, the Canadian dollar, AUD USD, which is Aussie, and New Zealand dollar versus USD. Crosses. We won't be talking about this because you're not going to be trading crosses or exotics. How to read quotes. So basically, if you got Euro USD, the euro is the base currency, as I said earlier, and USD is the quote currency. So Euro USD, that means 1 euro is what you're buying. It's worth $1.13 in US dollars. The base currency is always the first one listed in the pairing. So if you got Euro USD, if you got USD JPY, if you got GBP USD, the first one is always the base currency, the one you're buying. Pips. So pips can get kind of confusing, But to break it down, a pip is basically just a price interest point. So think about it this way. It's a way to measure in forex how much you're making, how much money you're making, or how much a currency is moving. It's the way you measure currency value. So in this example, we got Euro USD, and it's 1.13302. That two is the number that we're watching. That's your pip. So if that two goes to three or four, then it just went up 2 pips. Currency pairs that include the US dollar, a pip is 1/10,000th of a dollar, whereas when the currency pair includes the yen, a pip is 1/100th of a yen, because the yen is closer in value to 1/100th of other major currencies. So don't get all confused with that stuff. We'll go over that in the group, but pretty much the USD JPY moves a little. It's measured a little differently than Euro USD. If you use, let's put it like this, if you're using a $1 lot, like a full contract, and USD JPY, let's say it goes up 10 pips, that means you just made $100. If it goes up 20 pips, that's $200. So that's kind of the easy way to measure it. Spread. So the spread is the difference between the sell quote and the buy quote. The higher the liquidity of a currency, the lower the spread. So pretty much the spread is the broker's fee. It's just like trading. They take a broker fee. So the broker will take like $6.95 commission. With spreads, it's a little smaller with Forex. So let's say you're selling Euro USD. The selling price is 1.0992. The buying price is 1.0994. So the spread would be 2 because it's the difference. So you're paying 2 pips. So that would mean if you do a higher, you're gonna take that 2 pips. But if you're doing a lot size of 0.01 or 1.0 or one full contract 1.00, then you have to multiply that in your spread in. So that's how much you're gonna pay the broker. Which, like I said, when you're reading this, I don't like to go over all this stuff because it confuses people. They don't understand until you actually dive in, which is what we're going to be doing on day 2. This is just day 1. I want you to understand some of these terms. So what influences the market? The central banks, the national economy, and politics. So interest rates, inflation, deflation, employment statistics, change of government, stuff like that, change of officials, all of that affects the economy, affects the market, and that can make shifts in prices. So you definitely want to pay attention to those things, and we'll talk more about that, like I said, later. These are key figures who you need to know when it comes to news events, or if you come to the currency that you're choosing, you definitely want to know who these people are, because because they can move the currency with one word, just how Donald Trump can move the stock market. It's the same way with these people. So you definitely want to be up and up on this stuff. If you want to be a good trader, you need to know. It's kind of Trading isn't hard. You just need to know what's going on in the world. So government and central banks. The biggest players of the forex market are governments and central banks that buy and sell currencies to balance the economic growth and price stability of their nations. The amount of money used by central banks is enormous, so their actions have a deep impact on the currency markets. This is true. This is facts. Commercial and investment banks. Big banks trade billions of dollars daily. They make transactions with each other, with their customers, or they themselves speculate on the forex market. The 5 biggest banks are Wells Fargo, Industrial Commercial Bank of China, JP Morgan, China Construction Bank, and Bank of America. Big banks. So big bank take little bank. You definitely want to know about these banks because these are the market makers. Large corporations control large amounts of money, so when they move their assets in bulk, it can influence the currency rates. Individual traders, that would be us, retail traders. The most popular forex trader is George Soros, who is famous for breaking the Bank of England and earning 1 billion in a day. He also earned 790 million by speculating on the fall of Thai baht. So this is very true. He's one of the big players in forex, and he's a grimy guy. So he can move the market any way he wants at any time. So you have to be careful when you're getting in certain commodities like gold and stuff like that, oil. Leverage. So your secret weapon is leverage. That's how you can make a lot of money in forex with just a small account. Through the use of leverage, you can invest a small amount while trading larger positions through the loan from your broker. When the trade closes, your broker deposits the money into his account. All processes are made automatically through the trading platform. Leverage is presented in the form of a multiplier that shows how much larger the open position is against the margin, the actual investment amount. So basically, what your leverage is, I use 500 to 1. So I just multiply, let's say I put in $500 in my account, multiply that by 500. That's what it looks like I'm trading with, because the broker's going to loan me that extra money because they're betting on me to lose it, and they're just going to get my $500 anyway. So it's kind of like the casino, but they're giving you a little loan, but you're not going to lose if you stick with me. So the typical options of leveraging forex include 50 to 1, 100 to 1, and 200 to 1. In the US, the maximum allowed leverage is 50 to 1. Anything above 200 to 1 is considered very high risk. So I'm for you all buying this, and you're in the special group. If you want to really trade with real money, I'll help you set up your real account. Do not use these American brokers, these US brokers. You're going to be having a 50 to 1 leverage. You're not going to make any money, and it's trash. Trust me. I have a special brokers list, and they hook my people up because I've been doing this for years. So if you want to set up your account, definitely reach out to me. I'll help you get your account set up. I'll tell you which broker to use. In order to open a $10,000 position, you can use a margin of $200 with a leverage of 1 to 50. So 200 times 50 is 10,000. So basically, if you start an account with $200 and you're using a 1 to 50 leverage, you're really trading with like $10,000. But what we can do is we have 500. So you do 200 times 500. You get what I'm saying? You got way more leverage. How to read charts. So there's three type of charts. There's line chart, there's a bar chart, and there's Japanese candlesticks chart. We won't be using the bar chart and the line chart. We use that at the bottom of our graphs. And Japanese candlesticks is what you would need to be able to read charts. So I'm gonna skim through this. Bull market. A bullish or bull market describes a rising market that shows confidence and stability. So all you need to know is like a bull market is basically it's a buyer's market. That's when everything is up, everything good, everybody's buying stuff. You want to buy currencies for less. You want to definitely. This is a time when the market is strong, employment is strong, everybody's happy. Bear market on the other side of the spectrum is bearish. The declining market increases insecurity among brokers and investors who expect trends to go downward. This term is used to signify the market behaves the same way as a bear in a fight by pushing down to the ground. A bearish market is visualized in charts with the color red. When you feel confident that the bear will soon overtake the bull and expect currency rates to fall, you would sell short. So basically, to simplify, you borrow currency from your broker, and when the currency price falls, you pay back the broker at the lower price, that's making a profit on the difference. So that's basically what selling is. When you sell or go short, going long means buying. Going short means you're selling. So a line chart, we're not going to talk about line chart too much. It's the most basic chart type, and it's created by connecting several data points together with a line. This is a bar chart. We won't be using this. Candlestick chart. So this is a page you definitely want to study. The dual nature of the financial market is portrayed in the bullish and bearish market. So a candlestick, if you see the red one, that's bearish. So that means that it closed lower than the one before it. So price decreases. The right one is bullish. The price increased. So it closed higher at a higher price than the one before it. So you can see if you look at the bearish one, you see A and you see B. That's the body part. That means it's the opening price at A. So it opened at the body and then it closed at the body. And then you see the wick. Number one is the highest price it was during that period, and then two is the lowest price, and then same thing for the green one here. So we have A would be D would be the opening price. It opened higher and it closed higher, closed up here. And then the highest price it hit was here and the lowest price was here. So we'll talk more about those as well. Don't get too caught up in everything now. Just want you to start getting some a basis. That's all you need right now. Don't take this too serious right now. Just go through this and kind of take it all in, and it'll make sense. Trust me, it'll all come together. So yeah, multiple time frame analysis. The market can be analyzed in several time frames: minutes, hours, days, weeks, and months. Um, Analysis of longer time periods indicate particular trends, ignoring minor accidental changes, whereas daily and hourly charts are used for choosing the perfect time and open and close a position. So me personally, I'm always on the hour, I'm always on the daily, I'm always on the weekly, I'm always on the monthly. Monthly, I'm looking for long-term trades. Weekly, I'm looking for semi long term. The daily and the hourly, 4 hour and hourly, and even the 15 minute. I'm looking for um short like swing trades, maybe a trade that I'll do for the day or within 2 or 3 days. So um it's different strategies, but you definitely want to get comfortable with looking at charts and being able to understand the highs and lows, support and resistance, and that's mainly what you're gonna learn in this boot camp is price action. No indicators, any of that, because when you get too much in indicators, you aren't trusting yourself. You're not getting to the roots, the basics. You're trying to focus on indicators and all this false stuff. You need to focus on price action. And that's the best way to learn at the beginning is just finding out where the support is, where the resistance is. And we'll talk about that. It's going to be exciting, trust me. I love teaching people how to do this stuff. It's not rocket science. So this is a daily chart. This would be like a monthly chart. As you can see, like it looks like here you got kind of like a downtrend going on. But when you see on the monthly, you really see it's an uptrend. So trends, as I was just talking about, charts help you understand the overall direction a currency pair is going. The data points show either upward or downward trends, which helps you decide when to buy and sell. So this would be an upward trend because you see you have point here, point here. This would be your support. Oops. This would be your support, and then you have resistance here, but then resistance moved to here, and then now it's up here. So this is an uptrend. Downtrend. You see here you had support, resistance, and then support coming out here. So you see a downtrend. And a horizontal trend is usually when we don't want to touch the market. You're just gonna have, I mean, you can touch it, but you got like a simple support, resistance, support, resistance. This is how you practice support resistance. You just always plot the lowest and the highest mark. So trend length. There are three different categories of trend length, trend duration in forex trading. So you have intermediate term trends, 2 to 3 weeks, long term trends, several months or longer, short term trends, a few hours. So if you're looking at trends on a chart and you're looking at like a long term downtrend, then you know okay the overall market is going down, like a long term trend. If you're looking at 2 or 3 weeks, then you know, okay, I can get some good money right here short term. And short term, few hours, you're looking like a quick in and out. So when to trade Forex. The Forex market is open 24 hours a day, 5 days a week, but is not active all the time. In Forex trading, profit is being made when the market is active and traders are bidding on the prices. Therefore, it is crucial to know the most productive hours of the day and of the week for Forex trading. So this is a little picture of the different sessions. So you got Tokyo, Sydney, New York, London. You want to trade when these cross, when London and New York cross. So this is when it's really active at 10. And then I like Tokyo session as well. I use Tokyo session basically to see my setups because there's a lot of activity. I hardly ever trade Tokyo session, but I trade around this time, like 8 to 10, 8-11. That's when it's most active. But yeah, I'll check out if I'm up. Sometimes I'll catch the London session, but I just look for setups during these times. And I only trade usually Tuesday through Thursday. So best sessions to trade. There are three major sessions of the Forex market: London, US, and Tokyo. The Forex market in London is usually the most active as it involves many countries of the European Union. US market comes next, so the time when London session intersects with US session usually provides the biggest returns, which is what I was just saying. The money days. So according to researchers, the biggest movements in the four major currency pairs are observed on Tuesdays and Wednesdays. Fridays are busy as well, but only until 12 a.m. So yeah, I only trade mainly. I look at Monday, sometimes I'll trade if I see a setup, but usually Tuesday, Wednesday, and Thursday I'll trade. And Friday is when I'm really taking profit. When not to trade. Experienced traders avoid trading on Friday afternoon and weekdays on closing session, on bank holidays, on Christmas, during primetime TV events, when economic reports and news are released, and when they're angry, frustrated, or exhausted. So definitely keep this, put it, stamp it in your head. Do not trade when you're angry, frustrated, exhausted. Don't trade trying to revenge trade. Don't trade on bank holidays, on Christmas. Don't do any of that. And if you're in my mentorship group, my support group, you'll know. So these are a few tips for success. You can read over these. Start gradually. Always have a stop loss order. Rule of 1/6. Don't risk more than 1/6 of your account. Stick to a plan. Always have a trading plan. Multiple time frames. Always check out the hourly, the 15-minute, the 4 hour, the daily, the weekly. Don't stop the profit. Sometimes when you're up, you know, don't get too greedy either. Trends last longer than people think, so just play it smart. Never play against the trend. That's how you blow an account. If there's a downtrend going on, don't think you can bet and you know when it's gonna end, because you never know. And close the unsuccessful. Don't be scared to close out a trade that's not going in your direction. Just take the loss. So what's next? Once you have the basic understanding of forex, it's time to open a demo account, and I'll be going over that in the next training. So I'll see you there, and hopefully you enjoyed this. Go back over it if you didn't understand something, but like I said, it'll all come back together, and I'll see you in the next training.